I am super excited to have you with us today. We're here with another luxury short-term rental podcast. And tonight we have an extra special guest, Derek Barker, a very, I would call you a famous superstar in this space. You and your amazing wife, Brittany, that has come up with a pretty unique solution for short-term rental hosts and investors who are experienced with STRs in the space. So just really excited to share with our audience some unique products that you have available. We've been doing a number of different funding solutions over the last couple of sessions or so. Last week, we had a session with doc lending. So we have a lot of medical providers in the space. So this week, I'm really excited to come at you all with Derek. So Derek, I would love for you to introduce yourself to the people.
All right. So yeah, Derek, I'm the CEO and co-founder of Nectar. We provide cash flow-based financing to real estate entrepreneurs, people who own and operate rental properties. We've done a lot in the short-term rental space. Before that, so I started my career really as an entrepreneur. So I started my first successful venture when I was a freshman at Harvard. That's also where I met Brittany. We were in the same freshman dorm, actually. We lived in the same place. Then I ended up getting into real estate my senior year in college. So I kind of wrote that started buying properties. I also worked in finance as a bond trader on Wall Street. But I really spent most of my career, since 2013, buying apartment complexes. I'm from Southwest Atlanta. It was a place that got really hard hit by the financial crisis. And after college, I was pretty focused on going back home, buying blighted apartments, making them the nicest apartments in the neighborhood, renting them out, and did about $450 million of that type of deal volume, of that type of deal. And then along the journey, partnered up with Brittany. We've done several businesses together, but we built a 125 unit short-term rental portfolio. A lot of it was in our apartments. Some of them were standalone. But that was kind of our business, and that was our focus. And we saw how much cash flow you could make in the short-term rental business. We also saw just how challenging financing was then and is now. Even if you're like us and you've done a bunch of, we had done $100 million in deals, more than that. And so but even for us, financing was a challenge, because you had get a mortgage, but that's still not going to get all the cash you need to build your business and to buy your next property. And so that's what we started. That's what we started Nectar, so that people who have a portfolio that's cash flowing, whether you're an operator or your owner, you can leverage that cash flow to buy your next property or to put up, for furnishing or whatever working capital needs.
I love that. And so tell us a little bit about your personal insights and experience with the challenges associated with running a short-term rental business. I know Brittany was super host on Airbnb. Could you talk a little bit about that and the transition into Nectar full-time?
Yeah. So, we got started. We had I'll tell you a little bit about our first short-term rental, and then how we became, how she became a super host. So our first short-term rental was we had an apartment complex. Excuse me. In Atlanta, Georgia, downtown. And we were running it and it was fine. And we were like, hey, why don't we try this Airbnb thing? So we got 2 units, and I was sitting there putting the furniture together, went to IKEA, IKEA, we didn't know anything about what we were trying to. I would say, like, nothing against IKEA. It's not if you want things to last for a long time, it's not your best bet. But we were putting together IKEA furniture and got it up and got it listed. And yeah, we just like really it was just us just kind of trying to figure out how to make a little bit of extra cash flow out of our properties. And it went well. We put it up. This is 2017, wasn't a lot of competition. It was all, so we start a couple weeks later is started getting booked and just learned all the hard lessons one after another. And we ended up just start with those two, then did a couple more, um build out a team. We had to deal with all the issues, so from people throwing parties to trafficking to shootouts. We had a lot of stuff go down and we learned a lot. Nah, but some of the finances was challenging is lenders don't get it, like now there are a lot more options. There's some really good lenders out there. But when we were first starting, lenders were like, they did not get it. And even still, like when you buy a property, like you buy, we were fortunate enough to have some cash, but we buy 2-3 properties and then your cash is in your properties. You don't have, even though you're cash flowing, you don't have the cash to go buy that next property. It's in your, it's already in, the deals that you've done. So that's where, that was perpetually the challenge. We started raising equity from investors, and investors are great. They give you the money you need to do your deal. But they're going to take most of the upside. They're going to take 70% of the upside. You're going to have to pay a preferred return. And so, after doing that for a while, for, several years, we're like, oh, there just has to be a better way, where somebody like us who have a bunch of cash flow coming in, how can we borrow against this? And that's kind of where we started Nectar. It came in 2020. We had a cash flow portfolio. We were under contract to buy an apartment complex out in LA. Our earnings money had already gone hard, and then our lender pulled back last minute. They were like, they were like, oh no, and it left a gap in funding. This is March 2020. So they had their reasons. There's some, pandemic or something going on. But for me, I was like, what, like, this is crazy. Like, the deal was supposed to close in 3 weeks and I have to come up with over $100,000, well over $100,000. And that's where we came with the idea. What if we could just borrow against this cash flow that we're generating? And it turns out like a lot of people have that feeling like, hey, you're generating cash flow, but you don't need $5,000 that's going to come through this month, or $12,000 is going to come through this month. You need $150,000 in order to get a deal done, in order to get something done. And just to start next year, so you can borrow against that cash flow.
So I think that's really unique. Okay, you and Brittany are Harvard grads. You get a high, paying, very well-positioned job in Wall Street. And it seems like you're leveraging that experience to enter into this space, because the concept of borrowing against cash flow is something that's foreign to me, and it's something that I think is going to be foreign to a lot of our listeners. So could you kind of expound upon that? How did you make that connection? Because I have found myself in that position. It's like, oh my goodness, I promise you there's money coming. Like, can't you see it? Why won't you do this deal with me? Those growing pains when you're starting out, it's like, why can't we make sense out of this, right? And so I just love that you leverage that knowledge and you've pretty much infused this into a space where we hadn't seen anything like that before.
Yeah, I mean, yeah. So as you mentioned, when I left college, my background, like the neighbor, like where I'm from, there's not like a lot of capital. It's like not and I knew that was going to be an issue. And so like after college, I made it a point to I got a job at Goldman Sachs. So I figured that's where people know about how capital moves, and where I can learn about risk and how to gain access. And by not that I knew anything, but I just like looked up into getting a job where I was trading structured products, where literally we were trading bonds, which all these bonds were loans against cash flow. So like one bond I would trade was a tobacco bond, which is literally the tobacco companies got sued by the states, and the states like were getting a stream of income from the tobacco companies. Still get it, still going on right now, and they just borrowed against that. And now, and at Goldman Sachs, we were trading those bonds, and so I've seen it happen. And like if you can if a state can borrow against a tobacco revenue stream from a tobacco company from some lawsuit that happened like a decade ago, then you should be able to borrow against your cash flow on real properties that you're operating. So I don't know. Yeah, you just take little things from different parts of your life and kind of put it together.
I love that. And so with that, you're able to create a platform that just really differentiates itself from, I think, most of the lending products that, if not all, that we're aware of. So I think that's very, very interesting. So can you explain a little bit more about Nectar and how it plays in the capital stack? Because I don't want any of our, real estate investors and our short-term rental hosts and our accredited investor, I don't want them to miss out on the variety of roles of the capital stacks that you have within Nectar.
Yeah. So here's a good use case. Like, so one thing that's important, we are not a mortgage, right? But we are specifically set up to work with your mortgage lender. So like the way you're going to typically put the deal together is you're going to get a mortgage debt, and then you're going to get equity. It's either your cash out of your pocket or from investors. Well, we're something that's neither of those really. We're not equity because we're doing typically 1 to 5 year terms. Typically it's going to be 3 to 5 years where you're paying us back a equal monthly payment. So we're not getting any upside. So at the end of that, say 3 years, we're gone completely. You keep your property, you keep all the upside. If rents have gone up in that amount of time and you're getting more, we don't get to participate in any of that. But we are, because we're not a mortgage, we don't have a lien on your property. We can't force you into foreclosure, which means that our cost of capital is going to be a little bit more expensive than a mortgage also. So you get a mortgage, and then typically we will come in after that to provide that, you can use us in place of getting an equity investor for the down payment. If you have a property, if you have a portfolio and you're buying a new property and you need to renovate it, you can use our funds for renovations. We've put, people have used us to buy other management companies. People have used us to put in, hot tubs into the backyard. People have used us to finish construction projects. But largely anything that you think, oh, you have to come out of your own pocket for, or you have to get an equity investor for, that's a perfect use case for us. We've got someone use us to hire, an acquisitions person that then they win and they start continue to buy more properties. So those are some good use cases. So kind of how we can fit in.
Okay. Go ahead.
I was going to say another important thing is like we don't restrict your use of funds to the property that we're financing. So let me explain what that means. If you have 4 properties and we finance and we are financing those 4 properties, you don't have to put that money back into those 4 properties. You can take the funds and put it into buying another property, or put it into buying another business. It has to be a business expense, but another business expense that's not related specifically to put to those properties. And that's the way that we really differ from asset-based financing using like a mortgage or equity.
So that brings me to my next question then. So Derek, what would you say would be some of the qualifications that Nectar would be looking for to work with an individual looking for this type of product?
Yeah, I'd say one big thing is experience. Like we're not set up for your first Airbnb. It's just that, it's something where what I learned is that you learn so much in that first year. We learned so much in that first year, and sometimes it costs money to learn those lessons. And we're just not set, we're not set up for that. So like you have to have at least 3 years of experience. That's one qualification. Your properties have to be stabilized. We're only looking at stabilized cash flow. So we're looking at, okay, how much money did you make last year? You have to have actual financials from the last year that we can look at to see, okay, this is how much this property is making. We're not just going to look at projections and what you think you're going to make next year. And then a business bank account. You have to have the property has to be an entity, or if you're a management company, you have to have an actual LLC, actually company. And the bank account has to just be a company bank account. So it can't be like, your property and then, private school and, lunch, brunch with your friend on Sunday and like, all that other stuff. Like, we don't like, commingle personal and business expenses. Is really difficult for us to work with that. So those are going to be the primary things we're looking for. So some amount of experience, actual separate business account and business entity, and an actual performance, actual like 12 months of actual like cash flow where you're making making positive net income.
I love that. And I know our listeners are going to have questions, so feel free to add them to the chat wherever you are watching us, and we will be sure to circle back in and get those questions responded to. And so let me ask you this. I think this goes hand in hand with what we were just talking about. So outside of the experience and the net cash flow requirement, as well as the business entity setup, having those in place, what would you say are some of the most common misconceptions or misunderstandings around this particular product?
One is like, we're not going to replace your mortgage. Like, if you can get like a mortgage is going to be cheaper, it's going to be more restrictive, but it's going to we're not going to replace your mortgage. Like you're going to, probably want to get a mortgage if you can, if you don't have one. Another thing is, like we move really fast. So our first deal we can get done 6 days. A follow-on deal we can do in 24 hours, as quick as 24 hours. We can only move as fast as you can move though. So you get some people that come through and say, hey, here's my information, I want to close tomorrow. And it's like, okay, well, like bank statements or like operating agreement, like we need these things. So like, if you have your stuff together, then we can move super duper fast. And as I said, like very easy for us to get a deal done in 5-6 business days. I'd say we're paying attention. Like I'd be remiss if I left the conversation without talking about what's going on in the general macro environment. Like I'm very interested, Rachel, in what you're seeing out there and what you're hearing from your guests and seeing because interest rates are higher. Lenders are pulling back, and there's a lot of supply out there, and it's in 2017 it was like anything you put out there and put on Airbnb was going to sell out and you're going to make a ton of money. It's not the case anymore. Now it's a case where, in what I'm saying is like the people who are professional, like like really focusing on hospitality, really focusing on having their their ducks in a row and being organized and providing a good quality experience and not in running it as an actual business, they're outperforming the people who are in markets where it's a regulated market, but they have the licensing, all like the basic and we're definitely seeing that. We're definitely watching out for that. Is that what have you seen about around those things, Rachel?
Yeah, similarly to you, Derek, those who are putting the permitting in place are going to be the winners, because they are going, I would say they were going above and beyond what most who are hosts are willing to do. And so although regulations are definitely important and you must take that into consideration, but as long as we know what the regulations are, and as long as it's not unfair regulation where it's a complete ban across the board, if they delineate, what needs to be done and you're able to execute that, I think, it's an opportunity to set yourself apart, right, from those who are just either not willing to take the steps to complete it, or unfortunately, those who are going to operate illegally and then face fines and penalties. So I'm seeing that. I'm seeing those who unfortunately had overinvested a couple of years back, who are really impacted negatively, unfortunately, because they overpaid a couple of years back. And so really getting laser focused on a buy box that is within a reasonable margin, I think, is important. Just because the numbers look a certain way for a particular market, just being a little bit more conservative, I think it's going to be important. Underestimating expenses, underestimating taxes, right? Underestimating insurance, all of those things need to be taken into consideration for your expense ratios, and not knowing those percentages could really put you in a position where you're going to be tight month after month after month and not have any of that margin. And so before, where there was a ton of wiggle room, well, you're not going to have as much wiggle room. So it's going to be really important to be very strategic and to spreadsheet out every single deal and make sure it pencils out. No more set it and forget. I know I sit with my asset management team. We're looking at our numbers every couple of days, whereas it used to be, once a week, where we're looking at it every couple of days. Okay, where are the bookings? Where's, what are orphan days? Because we want to make sure that the ship is tight, and we want to make sure that we're taking advantage of every opportunity, because otherwise you're leaving money on the table and travel is still happening. I mean, if there are people wanting to book, I want to take advantage and make sure that I am one of the properties that's visible, that they can see it, because the algorithm didn't boot me off for whatever reason, which happened, right, a few weeks back. And so all of those things, there's no more set it and forget it. Not to sound weird, but it's time to get intimate with your numbers, people. It's time to get up close and personal with your numbers. And so those who are able to do that are really bolstering themselves, but those who aren't are really taking a beating right now.
That's so true. That's so true. We get intimate with numbers. But and the people who are like, yeah, the people who are tight with their numbers and are paying attention and know what those expenses are and keeping expenses tight,
Yeah.
though, it's hunting season for them. And if you're not one of those people hunting, then
You're on the menu. You're on the menu, my friend. You're getting ed up. All right. So let me ask you this. Could you share some examples with us? I know you actually shared a couple with individuals who actually leverage Nectar to build their team, and a variety of other examples. Could you share some examples where, say, the deal didn't go through or the deal went sour? Because look, we want to be an open book. We want to share the good, the bad, and the ugly.
Yeah. Well, we've had pretty decent underwriting guys, centers. So we haven't had a lot of people who who've defaulted, but there have been a lot of deals that we turned down a good amount of deals. A lot of things that happen that not having your numbers together, or you get a P&L and it says that you made $200,000 last year. Great. We'll do this deal. And then we look at your bank account and it's not even saying the same picture. Those, we had a deal that we got all the way through, and we always are going to verify bank accounts. We're going to look at public records. We're gonna like do these things. And like, we had somebody had 198 NSF fees, things like that. Like that we don't like, if you have NSF fees and other people aren't able to get their money, like I'm not going to give you money and then the NSF fee is going to be me. You know what I'm saying? So like these are things like that are like big red flags that it's like they're kind of like don't pass go. Even if everything else looked good, property looked great,
Red
the
flag.
PN it was okay, but like we have seen a lot of like people who bought and the numbers were tight in 2022. A lot of the deals that got done then, and they were thinking that things were just going to keep going up. And then like now it's the expenses are higher and the revenue is about the same or lower, and things are just like, and they're like bumbling along and struggling, like, or like supplies come, especially for some of these deals where it's another 2-bedroom apartment, and there are like 25 other ones in the same market charging the same rates with the same IKEA furniture and and same painting on the wall. Like those have had a tough time. We've seen a lot of them, and it's hard for us to get comfortable there and get those deals across the finish line.
And I think that's really interesting that you would mention that, because that's one of the struggles that I have as well when you're not able to kind of differentiate yourself in the marketplace. So even if it's a property that's not up to par when I first see it, but if I can see the potential where you can add something, add that value to differentiate it from the marketplace, not being a non-cookie cutter property is really important to me as well. And so that's why I focus on like the single family homes. You could kind of make it into its own thing versus identical. And because with identical properties, you're almost, always compared to the other identical same square foot property. No matter how much grass I put on the wall, I'll probably get a couple dollars more, but so that's my biggest concern with that. So
the bottom for price.
yeah, and it is a race for the bottom. So that brings me to the next question to you then. Are there specific asset classes that are just a non-starter for Nectar? And I know that we have a lot of unique asset classes these days. I was driving through Oregon, I saw a hammock on Airbnb. Could I borrow against my hammock?
We'll definitely look at your hammock. We'll look at this. I'd say we aren't going to do office, like, I know that like, not a lot of people are like doing offices, but like we also aren't doing offices. I mean, we have a pretty open mind. I'd say send it up. If it has good margins and it's cash flowing and it's been doing it for a while and you have experience doing it, like we'll take a look and we'll be pretty open-minded.
So like unique stays like yurts and things like that, if they're doing good. Oh, that's interesting.
We'll look at all that stuff. What we won't do is if you have a mortgage coming due next year, like we're not going to take refinance risks. So like we're not going to like have
tell me that like I'm 5, because I'm not catching on to what you're saying.
So we don't want our financing to be our term to be longer than your mortgage.
Okay.
So like if you want to do a 3-year deal with us or a 5-year deal with us, then your mortgage needs to have 4 or 6 years left. Like we don't want you to have to pay that mortgage back before you pay us back, because people are having a tough time getting those refinances done, and you don't want to be behind that. That's something I look at. And like now, I know that there's the hope that interest rates go back down, but I lock in long-term debt if you can get it right now, because interest rates also very well might go up. Tell you what, there was a lot of time in the 70s where people thought that it's over and interest rates are going back down, and interest rate went up. Mortgage rates were 18%.
Yeah,
out of our lifetimes in the 80s. Right?
Yeah, my parents remind me all the time when I'm complaining.
So that like, and you say, oh well, that's crazy. It's not. Is that crazier than 2% and 3% mortgages? I don't think so. I mean, it's a very similarly crazy. So, like, as a matter of fact, like where mortgage rates are at right now historically is not that bad. So I say, like, if you can lock it in, you probably it's safer than having to refinance or get another mortgage later on.
That's a good point. That's a good point. Okay, so let's talk a little bit about risk. You mentioned risk a little while ago. So how does Nectar handle risk for yourself, for its users, especially with all that's going on now?
Yeah. The biggest thing for us is we're looking at margins and like and consistency, professionalism. Like, so like if you have like professional financials that go back the past 12 months where you can see you're making like good margins, like that's the primary thing. Low leverage. People who've borrowed a ton of money and are like leveraged to the gills, yeah, that's just not for yeah, this is a risky place to be in this environment. And that's how we measure risks. How much leverage do you have? As in, how much have you borrowed against the income and the assets that you have? And how much how much cash flow are you making? What are your cash flow margins? So a lot of people, when they apply, they'll send us revenue. Oh, I made, $500,000 in revenue. Okay, that's cool. But like, so okay, subtract out expenses in your mortgage. Like that's what matters. Revenue is like, people are making $500,000 in revenue and losing money every month. So like in these environments, what matters is like, if you need a lot, like if you have $500,000 in revenue, you're making $200,000 in cash flow. That means you have the wiggle room to take a 20% haircut. Things can get, like, the market can go down 20% and you're still good. And we really like seeing that.
Awesome, awesome. I absolutely love this conversation because I know that I have a lot of different medical professionals and other busy professionals who are at various stages of their investing journey. Some are very burnt out looking for ways to reposition themselves. So Derek, let me ask you about this. Some are actually midterm rental hosts as well. Any feedback on that?
So we did a lot of midterm rentals also.
Okay.
Both like just in my real estate portfolio and at Nectar, we've done some midterm rentals.
Mhm.
Um, it could be a good alternative. You just have to find like, what is your niche? Like, what's your differentiation? Why are people going to want to go for you? And then do you have like a good pipeline of residents? But I love midterm rentals. I think it's like it's like short-term rentals where you can still get better margins, except for you don't have to do all of the turning units and cleaners. I don't know. That's hard. That's like some of the hardest part of the business. Like, just always getting cleaners out there and turning units over and over. So,
Yeah,
love,
absolutely. And so that's why a lot of the members of our community, they love the short-term rental. And so do I, from the vacation rental perspective of the midterm rental in the suburban areas. So we do like one short-term rental, one midterm rental strategy. We call it our two-door strategy. So I love that. And it's great to hear that Nectar can help provide support for both of those strategies. So whether you're just starting out or you've launched and you have that experience, you've been in the business for a little bit over a year, and you need a property refresh, maybe the furnishings are a little bit stale, and you say, you know what, I need to up level, or whether you're looking to be a passive investor, you say, you know what, I'm not going to necessarily put my dog in the show. I'm not going to do that. I know myself, I have a very busy schedule. I want to do passive investing. I know that Nectar also has a passive product that I just heard about today, and I would love to. I'm always looking to share as much information with the people as possible. Could you talk to us a little bit about that?
Yeah. So Nectar we have a fund. that allow where we take all the advances that we make, which are really it's a portfolio of cash flowing properties. We take the cash flow of that portfolio, we put it into put it into a fund. And as a passive investor, if you're accredited, you can buy into that fund and you can get quarterly distributions backed by dozens of professional experience, short-term rental and long-term rental operators. And we pay, 12 to 15% annualized returns. With, you don't have to take you don't have to take lease up risk or construction risk. You're not worried about is it gonna refinance? You don't have to worry about the properties going up in value. This is just already stabilized cash flow. Where if you're an accredited investor and you want some passive income, you can invest with us and we'll pay you 3% every quarter. So 12% return off our preferred members. We can pay a little bit more depending, if you make a little bit larger of a commitment. So that's something that if you want to get exposure to short-term rentals, you want to get exposure to real estate, to the cash flow, but you don't want to do the work
Without lifting a finger.
Without lifting a finger, you can get those returns every quarter in your bank account. And all you have to do is log in and look. You don't even have to log in. You can get a ding into your bank account. So
that's awesome. And I know that we're looking into transitioning more and more into passive, because for me, guys, not just the ROI, it's the ROE, the return on energy too. That is the goal for 2023 and onwards for sure. So I'm super excited about that. So for our listeners who are interested in using Nectar and who meet that criteria that we mentioned a little bit earlier, you're an experienced investor, you've got your LLC, and your numbers, you've gotten intimate with your numbers, you have those margins that Derek is talking about, but you can use a little bit more cash so that you could work on getting, this next project that you have on the pipeline launched and on the way. Definitely a link. I'm going to add the link below. Just grab that link and we will connect you with Derek and his team at Nectar. Derek, any final words for the community?
I love to be a part of your journey and see if we can be supportive in any way. I've been an entrepreneur my whole life. I've been a real estate entrepreneur my whole life, and I love supporting real estate entrepreneurs. I love supporting entrepreneurs, period. So if there's any way we can help, come through, grab that link. And we'll put you, if you say that you come from Rachel, we'll put you at the very front of the list. We'll get to you first. And yeah, I look forward to being supportive and good luck out there. And also same thing with accredited investors. If you're an investor and you're interested, come on through.
That's right. Thank you, Derek. And guys, I will see you next week. Love you all to the moon and back. Bye-bye for now.